this latest news from the Federal Reserve about the purchases they're going. They haven't called it quantitative easing yet, but we heard from Sheila Bair that there is the concern out there about the refinancing of some of the corporate debt and that debt bubble perhaps that might be confronting markets. Is this a concern of yours?
It all is. And it's good to see the Fed finally focusing on market malfunction. You know, it started earlier in the week. It started in the credit market, then it migrated to the inflation market. On Tuesday night and Wednesday, it started hitting the Treasury market. So it's a very good thing that the Fed is finally reacting, because we cannot afford to have market malfunction start reverse contaminating what's happening in the real economy.
What about the reaction, not just from the Fed, but this announcement that we are reportedly set to get from the president today? I actually have to admit, I would have thought that would have reassured markets to some extent, because there has been criticism that the administration has not been proactive enough. But that's not what happened. We saw markets kind of come down to their lows after that.
So two things. Markets were losing steam going into that announcement. And they were losing steam for a very simple reason. In order to sustain a bounce, you need deep-pocketed buyers to come in to compensate for what will be a tail of distressed selling and what will be a tail of trapped longs looking to get out. So it's really important that you get the follow-up buying in a main way. We didn't get it. So we started weakening pretty well from the open. And then the announcement, because it's uncertain, no one quite knows what a national emergency means. But we look at Europe. Today, Belgium closed the restaurants. Spain announced an emergency situation. And all that is what's called an economic sudden stop. It brings everything to a halt suddenly. So markets are trying to figure out, what does this announcement mean?
Hey, Mohamed, Brian Chung here. So you've been extensively talking about the balance between monetary policy and fiscal policy here. It seems like the consensus is that fiscal policy needs to step up to the plate here. But I'm wondering, when you look at other corners of the world, we look at the UK, for example, where you had the Bank of England releasing its announcement alongside the budget being introduced in Parliament, and the Bank of Japan yesterday meeting with the Ministry of Finance in addition to the Financial Regulatory Authority there. I'm wondering, do you think the United States has been behind the ball in getting everyone at the same table? Would that spark more confidence? Is that what could actually be a circuit breaker, if you will, in the sell-off that we've seen so far?
So we're shifting to a whole of government approach, and that's absolutely critical. And while the Fed is not government, it is a really important agency. So when I say whole of government, I mean also the Fed. We should be one big orchestra playing the same tune with the same sheet of music. Thank you for citing the UK. The UK on Wednesday set a very good example, not only because of the Treasury Bank of England coordination, which is important, but also about how they're thinking about this. So it's not just cutting interest rate, throwing money at it. It is being very focused on where are the market failures, making sure that small and medium-term enterprises get credit. Things that are very detailed, but phase one is going to be all about protecting the most vulnerable segment of our population, the most vulnerable segment of the economy, and directing money to the medical sector. If you just cut interest rates, cut tax credit, it's not going to make people go to the movies. It's not going to make people get back on airlines. So be careful not to deploy your ammunition too soon when it comes to general policy. What the Bank of England did and the Treasury was very good because it was focused. And then the longer term, they had a path to higher infrastructure. What does that do? That boosts future demand and future productivity.
Mohamed, you just brought up, I think it was Belgium you said, is closing the restaurants. I'm curious, it seemed just a week ago a ridiculous question to ask, but shutting down a country, you can't shut down an economy. But what would it look like if we were to start to take the kind of actions we've seen in Italy and we're starting to see in Europe, where the World Health Organization, now the epicenter of the outbreak, what would it look like for us to take those kind of steps, and for how long?
So it will mean recession. It will make the global recession even harder, and it will make the restart harder. Look, there is an inherent contradiction that people haven't focused on as yet between current phase of health policy and the realities of our economy. Health policy, what are the words that are guiding us: social distancing, isolation, separation. And that's right. That is how you try and contain the virus until you develop the medical advances that you need. So on the one hand, you have deglobalization, you have basically shutting down economic activity. On the other hand, you have an economy that is not wired for that. We are wired for interconnectivity. We are wired for globalization. So you get an inherent contradiction, and in the short term, health will win this contradiction. So yes, I'm worried that people still underappreciate how fast we're going to slow and how hard it is to restart the economy.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.